Okay, guys, what's going on? Jay here, smarthelping.com. I've got an assortment of different data tables so you can run some sensitivity analysis for your manufacturing company, or it doesn't technically have to be manufacturing, it could be reselling. Um, got a lot of visuals as well for each table. Put a lot of work into this to make it look good, professional, and accurate. Uh, I'll go through each section. We got a basic price and volume analysis. Uh, Same deal, but with a variable cost as your main model driver. Then I did one with wage assumptions included, and there's a lot more sensitivities based on that and productivity. And then I did one with the same style input, but this is now isolating break-even price with a similar model here, except for no variable costs. So let's go through each one and see how it works. So first one's basic price and volume. All this does is it takes all the logic in this model, plugs it into this table, and you can see what the profit and loss is here at different prices and different volumes. And you can also change these cells if you want, and you see change here. But this gives you a nice range based on isolating price and volume and the resulting profit and loss. This table, profit margin, same deal, but it's using profit margin instead of the actual profit and loss, but it's showing you the different margins at various volumes and prices. This one, break-even volume, is showing you how many units you actually have to sell to break even if your prices are different and your costs are different. Uh, for example, the highest cost in the period and the lowest price charge will give you the highest break-even volume. So you got to sell the most to break even if those two things are true there. Break-even price, I really like this one. I think this is interesting. So if you change the volumes and the costs, this is the amount you have to charge per unit in order to break even. And again, it's using all the logic in this table here, but sensitizing these variables. Okay, so that's the first section, pretty straightforward. Next one, we're doing the same idea, but now we're adding a variable cost input. So now you've got price, volume, variable cost, fixed cost, total cost, profit and loss. And what we can define here is what is your break-even revenue at various variable cost levels and fixed cost levels. And note, like for manufacturing, your variable costs are going to be things that scale directly with volume. So that'd be like your um, material costs. Uh, you might want to factor in, it depends on the type of business, but just anything that directly scales, like if you sell 1,000,000 units versus 5 units, what costs change as you sell more units? And so that's that cost here. And then fixed costs would be more like overheads, managers. It could be labor. It depends on the labor. If you need more labor to scale more units, then that would be part of variable. But if it's like administrative staff, um, you know, bookkeeping, then that's not going to scale. So those would just be fixed costs. Um, and then again, you can see your break-even revenue. So here at the highest variable cost rate and at the highest fixed cost, your break-even revenue, meaning the revenue that you need to cover all these costs and have a P&L of 0, would be 121. And you can see if we put that into the model here, 30% and 85,000, then we don't break even until we sell $121,000 worth of products. So in that case, and we're doing price and volume here. So if we were to do that, it's about 3 times close to, I don't have an exact, but you can see when we get 30% cost, 85 fixed cost, revenue's got to be around 121 in order to cover everything. Profit margin table. So this is showing you same variables isolated, variable cost and fixed cost, but now it's showing you what your resulting profit margin is at these different variable costs and fixed costs. And you could change these if you change the price or sales volume, the margins will change. at those different levels. Now it won't change, like if I change this, that profit margin table won't change. If I change this, it won't change because those two variables are what's being isolated here. So the only thing that could change is price and sales. And that's the point of these sensitivity analysis data tables, is that you can hold different variables steady and see what happens to the P&L when you isolate other variables. So holding everything else equal, but adjusting, these two variables, we can see what our profit margins are. Okay, and then profit loss table here, but now we're isolating price and volume. So at different prices and volumes, so these two, and you're holding these two inputs steady, what is your profit and loss? So here we know we're not making a profit until either the price has to be over $7 if we're selling 8,000 units or more, but if we sell 6,000 units, we're only profitable at a $10 price point. So this is a good table. Profit margin table, same thing as the top, but now we're isolating price and volume instead of variable costs and fixed costs. So at different prices and volumes, what's our profit margin? Okay, so those are the two basic tables. Gets a little bit more complicated now. Now I've added, we still have variable costs, but I've added labor wages and productivity. So now this is saying how much volume are you getting per labor worker, and then also how many hours in this period that we're measuring, which could be a month, a year, whatever. How many hours um, are your workers working in this period? How many employees are there or labor workers are there here? And then you got payroll tax and benefits as well, and then fixed costs. So now we've got a lot more variables, so we got a lot more tables because we can isolate different things. So first you got break-even table here at different wage rates. So if we adjust the wage rate, which is here, and if we adjust the employee count, which is here, so adjust those two things, but hold all these other variables equal to whatever you input in here. This is the resulting revenue required so that you break even. So again, it's pretty simple. As you have more, as you're paying your workers more, and as there's more of them, the break-even revenue rises. And this one, profit margin, same deal. We're isolating the same variables, hourly rate and count, but now we're showing the resulting profit margin at these points. So if I was getting maybe 500 units out of each labor worker, now you can see these numbers all go up. Your break-even revenues don't change because this is solving for your break-even revenue, and this is a revenue input, so this is not relevant to the calculation. Next table, break-even revenue based on hours in a period per employee and the wages. So this is saying in your given period here, how many hours is each employee working and what's their average wage? And based on those two things, it tells you the amount of revenue you need to break even. As we go over here, profit margin table, same deal. Well, no, here we're actually adding a different variable. So volume per worker. So this is how much productivity given workers can be attributed to the amount of units produced versus their wage and the resulting profit margin. And then we got a profit and loss table with those same variables. So units produced per worker and period and wage, and what's the resulting profit and loss at those different levels. So if they're really productive and the labor rate's lower, then you're going to make more profit loss. Okay, this break-even table's hours. Oh, I talked about this one, hours and period. Profit and loss table, this is hours and period and wage rate, and then the profit and loss. And again, more hours. If your workers are working more and paid higher, you're going to have a lower P&L. Profit and loss table with volume. Oh, I talked about that one. Profit and loss per table. So this is a really good one. I like this one. So worker production versus the amount of hours working. So how many hours are your workers working in a given period? And then in that period, how many units are being produced per worker? So max production, lowest hours is going to give you the highest profit. And then as you go down, lower or more hours, the profit goes down a bit. And then same deal here, isolating worker production and hours per worker, and then showing the profit margins. So that's this table, and then you can adjust all these things, and then if the variable is being isolated, it will change if you're not targeting an isolated variable. This table is doing a very similar thing except for we're solving for break-even price on all these 5 tables. So it's saying what does the price charged have to be per unit in order to break even if wages are this, employee counts are this. And note the employee count going higher here gives you a lower break-even price, and that's because as you add more employees, you're adding more volume because we have a volume per worker input here. So your whatever your productivity is getting higher. That means its revenue is higher relative to your fixed cost. So your cost per unit or break-even price essentially is going down. And then as you raise the average wage rate, the break-even price is going up, but still, if you go from top to bottom, it's getting um, cheaper. Here we do worker production and fixed costs and figure out the break-even price. This one is worker production and hours in a period and giving you the fixed price. So how many hours are a given worker working in whatever period this is measuring, and what is their unit production? Okay, well, low production, high hours, meaning they're not producing a lot, but they're working the most amount, is the highest break-even price per unit, and vice versa. If they can produce a lot and low hours, you're getting a lower price or break-even price, holding all these other variables equal, such as in this case wage rate. So if we were to put wage rate up to 30, you see all these break-even prices are going to go up here. Employee count would also adjust that because it's not being isolated. Hours, this will not change anything because it's being isolated here, and this production is being isolated here, so that would not change anything. And then price per unit is what's being solved for, so that won't change anything in any of these tables. Fixed costs will definitely change things. That's one of the main things that's being held equal against all the other variables that are changing. Break-even price based on fixed costs and employee count, and then break-even price based on worker production and employee count. So these are just a lot of great tables to really analyze your business and figure out some different price points possibly. Just understand how much revenue you might need to break even, potential profit and losses as you hold all these different things, um, variables true or equal, and you change certain ones. What does it do to your P&Ls, margins, break even price, break even volume? So that's pretty much it. You can get the template in the link below. It'll also be listed on the vendor sites. One-time fee of $45. Else. I like all these visuals really make it a bit easier to see the trends of what's going on versus what variables are being isolated. Like on this one, you can see here's your price, volume, and this is showing you at different volume levels, how does your profit and loss change at each price point. So $5 here at 10,000 is showing you a P&L of just under 40,000, and then you're going up from there as you're increasing your price. And assuming you're selling 10,000 units, here's your P&L different prices. Margin, same deal, which is This is a nice one, volume and price. So at different volumes and different price points, what's your P&L? What's another good one? Your break-even price is pretty important to see at different employee counts and different worker production levels. What is the break-even price? So I think these are all really cool. This is just good to understand in general for any manufacturing business or basically anybody that is selling units in bulk or producing units in bulk and then selling them can use this model. All right, like the video, subscribe. I'll see you guys on the next one.